Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Welcome, everyone, on this week's FIN-LYT by EWA podcast, joined here by Jamison Smith and Jimmy Rogan, and most popular podcaster on the EWA team. We're talking all things estate planning, risk management, specifically for high net worth clients. You know, what are the best solutions from an insurance perspective that are out there that can fit alongside your wealth management, retirement, overall financial plan. So, yeah, Jimmy, why don't you start us off?
Well, I guess when we talk about insurance, we should probably just start with, okay, what are the types? Very, very quickly, term insurance. The way I like to explain term insurance, it's temporary coverage. As the name suggests, we recommend it oftentimes for clients, but it is for a short-term duration or, we use it if large amounts of coverage need to be accessed and we need to be cognizant of, budget. Then there is whole life that can be termed as permanent coverage, cash value. We recommend that when we have situations where we have high income earners and we're trying to assist in a plan that allows for tax deferred accumulation and what we call safe money. Because cash value life insurance, the insurance that is growing inside a life insurance policy, is pretty much, plodding along. It's not a grand slam, but, it's a consistent double, as we like to say. And then there's a variation of the two, which is universal life. And I think that's a product that I think is not understood very well in the marketplace. It's kind of like a hybrid of the two. It was devised in the early 80s when interest rates were really high. Since, that time interest rates have come significantly down. They're a little bit higher now, but those are products that really need to be understood because unlike term insurance and traditional cash value permanent insurance that has significant guarantees with respect to premium and death benefit, universal life doesn't. And so we need to monitor those policies very closely for clients to make sure that there are no unwanted surprises down the road.
No question. Well, Jamison, what have you seen from your experience? Let's focus in on that universal life before we talk about the structure. How often do you see policies that were sold with high expectations and now we're 10, 20 years auditing them and it's like you're going to lose the coverage 20 or 30 years before you pass? How often do you see that?
More often than I would like to. I think that they're grossly, I think they still are, definitely in the past, but grossly oversold and overpromised. And, there's a use case for them. Like Jimmy and I are working on a client now where we need, it's a buy-sell agreement for business owners and they need an appreciating death benefit and try to keep the cost down. And they don't really, cash value is not as important. So term insurance isn't going to grow with the pace of the business. So we're looking at a universal life policy to, keep up with the growth of the business for the death benefit. So there's a use case for them, but it's definitely not the way they're sold is that, you'll get some market-like returns in a tax-deferred life insurance policy. They generally underperform. They're capped at correlated to an index return, and they're capped plus expenses. So bottom line, they usually don't perform like they say, and the performance is not what the expectations are up front. But again, there are use case for them, but a lot of times it's not what people think they are.
Yeah.
Matt, the universal life allows for a lot of flexibility in the design. And so if you're an advisor, creating a universal life illustration for a client, and you go out of the boundaries of what should be a responsible assumption, and then you just sell it and then put it in the drawer and never look at it, which I think collectively we would agree we see that all the time from other recommendations, it can be a problem.
Yeah, no question. Yes, I would say just from the industry as a perspective, because it's gotten a lot of black eyes, as rightfully it should have. But like, I'm going to go through a couple examples. So there's a lot of influencers like Dave Ramsey, Susie Orman. They say, don't touch permanent insurance, buy term insurance, and invest the difference. The issue with this is that 95% of the population will buy the term insurance, not even the right amount, but then they'll spend the difference. And then after 20 or 30 years, or by 65, when that term insurance expires, and that's a use it or lose it. So if you die, great. If not, all the money you put in there is wasted. Now they still have an insurable issue. They need to be insured. But at that point, if they try to get term insurance, it's astronomically expensive. Their health may not allow, and they're out of luck, right? They don't have the assets to self-insure. That takes extreme discipline to become self-insured when you think that. And life happens. It's like we see it. Like a 401k alone, if you're a high income earner, is not going to get you self-insured. And you set a brokerage account, you have a kid, it gets rated. Then you refurnish the house, it gets rated. Then you update the house, it gets rated. You buy a vacation house, it gets rated. So it just typically we see that the self-insurance route, high income, middle class, it rarely works in the quick of a fashion as people think. Usually you need to have a layered term policy in place, 20, 30 year, 65.
Yeah,
really
the other thing I would add is on the off chance that we actually do see somebody who actually saved the difference, if they follow the planning that you mentioned from Susie Orman, they could be sitting in a situation in their 70s where they have all of their wealth tied up in qualified plans,
right,
and that's a tax disaster.
Yeah.
So, it can be complicated on both sides.
Absolutely.
If you save the difference and if you don't save the difference.
No question. So I would say like 95% of the population is fit to buy term insurance. You have to work with a competent advisor that's going to hold you accountable to invest the difference, and that's so important. And given success, you may want to look at other types of policies once your net worth, as Jimmy, you mentioned, gets to a certain level. That's term insurance, pros and cons. If you're going to go that direction, it takes an extreme discipline. You need to accept you're going to be different than most of your friends. You have to save a lot more than you think to become self-insured. And the discipline factor of that not rating the money you save, statistically, you're going to be, top 1% of discipline to make that strategy.
And be very cognizant of asset location when you're saving the difference.
Absolutely. Now, whole life, I would say on the flip side, it's a huge industry where people will start right out of school and they'll try to sell it to everybody. And I would say that's
how we started.
Yeah. I mean, we all started prior.
Absolutely.
Broker dealer selling insurance, and then you get your investment license. But the reality is like 95% of those sales probably should be term insurance, not whole life insurance. When someone's making 100 or 200 grand a year and they need to get a couple million of protection, they need to focus on that in the term insurance first, right? So with our clientele, generally probably top 10% income earners, or top 1%, and like you have a couple $1 million, you're high income, you're just in a different category of what is going to be a suitable need. So that's where we do focus a lot in the permanent insurance given our clientele. But we'll read articles or read out there, and it is missold to lower income people. But if you're in a higher income, it's extremely important to have permanent protection that's gonna last forever. And we'll give reasons behind that. So going into the whole life, obviously it's a policy that you mentioned, it stays in force forever. We're big fans of certain structures where kind of super fund the premiums. It's done in a short time frame, and that does a lot of things. And there's a couple of changes that just happened in the tax code and some riders that are available. So, Jimmy, what's the tax code? I always mess this up. 16 something?
7702.
I wasn't even close. No, what's the 60? There's some power of attorney tax thing we're doing at some form. 7702 is life. All right, the two main numbers in my head. So basically, what this does is the government, a lot of rich people will fund in life insurance for tax reasons. So it goes in after tax, but then it grows tax-free, and you can access it tax-free by recovering your basis or borrowing against a death benefit. Then when you die, that lowers the death benefit, whatever you borrowed, right? So lots of tax benefits. So ultra high net worth people say, oh, I can stuff money in here instead of cash being, the interest I earn in a bank or a bond gets taxed every year at the highest income rate. I can just stuff it in here and avoid that. Sign me up. Well, the government created this rule called 7-pay, where if the life insurance policy endows and under 7 payments, they view it as an investment, not a life insurance contract, essentially. And then there's lots of tax consequences. So the quicker you get this in, it's like paying a mortgage off in 15 years versus 30 years. The interest you save is astronomical, right? So in a life insurance, if you put the money in 10 years versus, let's say, 50 years of the rest of your life, the results you're going to see could be 2 or 3x on the growth of the cash, on the growth of the death benefit. It's crazy, but we want to make sure that the policy remains a life insurance policy so it stays tax free. So most of the policies we're recommending for high income earners, we're sniper shotting. It's like a getting it in quick, making sure it remains tax free in nature as a life insurance contract. But then that's going to operate as, risk management. That could operate as part of our estate plan and a trust. That could also operate as our safe money in cash because, investment portfolio is great if you have a long-term horizon. And so if you read out there and say, oh, I'm going to be risky while I'm young and safer when I'm old, I always have an issue with that because when you're risky when you're young, you don't have any money. So even if you hit the ball out of the park, it's on a little bit of money. It really doesn't matter. But what if you could be risky when you're old and you accumulate a couple million? That could be dramatically impactful your net worth. Well, if you have a safe pool, if the market does drop, which it always will about every 7 years, you can be 70 and see a 30% market correction as long as you have a different pool of money you can pull out of the year it drops and the couple year it recovers, no issue. And that's where this cash value, it's not going to get the same rate of return, but it's going to allow you to sustain greater returns forever on your investment portfolio. And a lot of people compare it. Well, what if sometimes a financial plan is about a support system? It's like the two can complement each other so well, especially for high net worth from a tax reason, from a asset protection reason, and obviously from a supporting your investment. So that's personally how I have my plan structured. I plan to be 100% equity investor for the rest of my life. Like I'm never going to have a bond allocation, but I'm also stuffing a lot of cash inside life insurance.
Yeah, we kind of use the analogy. It's like a Swiss Army knife. There's a lot of different ways in which these cash value policies can be very helpful in a plan. And another way of saying it is it's self-completing. There's cash if you live too long. There are riders that you can put on policies that allow for protection in the event of a disability or a long-term care event. And obviously there's death benefit that can be passed on either through trust or directly to beneficiaries. So, our clients are looking for us to make recommendations that support their plan and are very tax efficient. And that's where this is helpful.
And the other thing that, I don't know, maybe 7 or 8 years, I'm not sure of the exact date that the rider became available, called a long-term care rider. And this is, obviously an epidemic in America. So Jimmy, just give us a quick background of before long-term care only existed in kind of like a term life insurance.
Yeah, so they're called standalone long-term care policies. As insurance products are considered, it's a fairly new insurance product. It was devised in the early 80s, but essentially you pay a premium to the insurance company, and if God forbid you are in need of any type of long-term care, whether that's in-home care, assisted living, or skilled nursing, you would get a benefit paid. But if you would, for example, purchase the policy in your 50s, because that would be the time to do it, because from a health standpoint, you have to qualify. And these long-term care events generally, hopefully you don't have one, but if you do, odds are it'll probably be in your 80s. You could be in a situation where you're paying premiums for 30 years before you even need the benefit. And or, God forbid, you could have a situation where you don't need the benefit at all. You get a diagnosis that doesn't allow even for a long-term care event. Clients weren't really thrilled with that use it or lose it type of structure. And so what the insurance companies, what the marketplace dictated was, we need to make this more self-completing. Mm-hmm. And so they added a rider to these cash value policies, which allow for clients, if they do need long-term care, to basically take it tax-free from their death benefit while they're still living. So again, we come back to the Swiss Army knife self-completing analogy. If you have a policy that is structured properly, you'll have cash if you live too long, you'll have a death benefit if you die too soon, and you'll also have a death benefit available if you need long-term care. That is the direction that the marketplace has gone, and that's really what we talk to our clients about, because there's not a lot of appetite for paying for a premium for decades and not knowing if you're ever going to need the coverage.
Yeah, absolutely. So James, give us the example. The long-term care benefit is hugely impactful for market and taxes. So give us like a rundown of like in retirement why this could be so beneficial to somebody that is high net worth.
Yeah,
They could self-insure it, but maybe they shouldn't because of the market or taxes.
As I say, a lot of times, clients we work with could self-insure. They could, afford to pay $100,000 a year for a long-term care facility. But the two problems, exactly what you said. Number one, if the market's down and you have to pull from investments to pay for that, that could be detrimental. And the second thing is for tax efficiency. So, a lot of times clients will have a lot of their money tied up in qualified plans or Roth accounts. Roth comes out tax-free, but ideally, if we can leave that to pass to kids tax-free, that's ideal. Qualified plans, you may have to take out, an extra 30 or 40% than what you need because of taxes. So you're going to get pushed into higher tax brackets. Your Medicare cost is based on taxable income. So now you're paying more Medicare costs, and it's like the least tax efficient way. If you have a brokerage account, could use that, which could be a little bit more tax efficient. But the benefit of the long-term care rider on the life insurance is it's not market correlated, so it's there no matter what the market's doing, and it's all tax-free if it's used for long-term care. So
we're typically designing this to like if a client has, say like $3 to $5 million in retirement, and they're used to spending like their AGI is like 250. One spouse goes and passes. Well, now the tax bracket shrinks, and now we've got under 200 to go up to that 24% tax bracket. So now that surviving spouse has its money, they're fine. If they need a healthcare event, taking it out of their IRA or 401k, they're gonna be doing it at 32, 35, 37. Well, if they have this rider on the life insurance, they can take it out, eat up the 10 to 24% bracket on their assets, and then take this out tax-free. So now they're paying 0% taxes instead of 32, 35, 37 on the assets. And that just preserves a tremendous amount of wealth, long-term. So this, and like Jimmy said, it's not a use it or lose it. So I think, this is how I do it. It's how most of our clients do it. You're going to one of three things, like you said, you use the cash, the death benefit goes to kids, or you use part of the death benefit to cover the healthcare tax-free while you're living. And the government blesses the tax code primarily because a lot of people, percentage of the population will go on Medicaid, and that's what the government, once you've lost your assets, the government puts that bill. So they love when someone has a plan behind long-term care.
Anytime the government gives you a tax break, you should probably take it and consider it in your plan.
Yeah, absolutely. And there's a net worth. I mean, if you're under $1 million, you're having insurance. It's case by case. Kind of the 1 to 5 million, we call it the purgatory. Like you need some insurance. Like self-insurance is not guaranteed to work out. And then over 5 million, it's like you don't need it. You could self-insure. We did this. It's over 7 million. We figured out you don't need it, but you may want it if you hate taxes and like math. As far as like how the market works and yeah. So even if it's like I could self-insure, it's like, well, is it tax efficient? Is my wealth going to truly build to the greatest if that's the goal for intergenerational wealth? If I don't have it, and then we do the analysis, and we can. Again, case by case, but more often than not, this also sometimes is a need, but it's also a want because high net worth clients do not like paying taxes.
No, they don't. But the other thing, if we're talking about long-term care, there's certainly a financial component, but there's also an emotional component.
Oh my goodness!
And you got to think about: am I purchasing this for me, or am I purchasing it for my kids? Because if I'm in a long-term care situation, it's my kids that are taking care of me. Are they local? Are they not? How is there any coordination to the care and the plan? And unfortunately, I went through this with my mother a couple years ago. She was diagnosed with Alzheimer's. Luckily, we did have long-term care. They were not in a position where they could self-insure, so those benefits were extremely helpful. And the coordination that came from these policies was very helpful too, because it's one thing to go through that and have your kids see you deteriorate that way. But the other thing is if you throw a financial component on top, that adds to that stress. So you have to understand who you're actually purchasing it for.
No question. Well, to close out, so there's the universal life, and there's two different types of universal life. And I'm just going to cover these real quick. It's the guaranteed universal life. Huge black eye in the industry. People have said, oh, you can do this. It's way cheaper than whole life. You're going to get a 10%, like you said, interest rates back in the 80s, 10% return forever. Then what happened is these policies, they're a mix. So the mortality and expense ratios grow. If they don't hit the number that you built the premium structure off, if it hits 3% instead of 10%, the thing may not last till 100 years old. It may lapse at 70 years old. And that's what happened with a lot of these universal life policies. is expectations were set extremely high, and then the results were extremely low. And so there's a lot of money wasted, a lot of commissions generated for the people selling them, a lot of money made for the insurance companies, a lot of consumers that end up wasting money. So now there's been some reform, and a good advisor would structure it properly so there's guarantees backing it. You can do what's called a guaranteed universal life, whereas if you set the premium structure, no matter what the performance is, no matter what the expenses are, as long as you pay the agreed upon structure up front, it's guaranteed, and we can push that age till like 121 if we want to. 100, 105, 110. The longer, a little bit more you're going to pay. But estate planning, this can be a cheaper option. Not going to have as much cash accumulation. Sometimes it even goes to zero. But if we're just doing estate planning or business planning where we just need that death benefit when you die, not if you die, because this would stay in force forever, that could be a proper way to do it if we're not worried about the cash or the long-term care rider. So from an estate planning perspective or purely a death benefit perspective, the GUL, as long as it's a GUL, because a lot of times we'll see them sold as just UL, oh, do this, it's half the cost. And then, well, the thing's going to implode when you're 85. And if you die at 90, it's you just wasted millions of dollars, essentially, if it's a big policy. So if you're doing a UL, you just need to understand that the work with an advisor that sets realistic expectations or structures the policy with those guarantees. And then the other, the IUL, is, and there's some great policies out there, but you have to understand the policies work. So the IUL, it sounds too good to be true, where it's like, okay, we get the upside, it's indexed to the S&P 500, it's capped at 9, and you have the downside, which is expenses. We'll say it's like a negative 1.8. Well, they don't give you the dividends. So if you look at the historical returns, we're probably looking, and I've ran this through, an extensive analysis, you're looking between 4.5% and 5.5% most years. So great product. Again, if you and John Hancock specifically has this product called a Vitality Rider, where people can get credits if they do medical screenings every year. So incredible. But I've seen other advisors illustrate these at like 10% returns. If you look at the S&P 500, it's averaged over 10% in the last 100 years. But if you take the dividends out, and last year the S&P 500 did, over 20%, well, if you're capped at 9 and you compound that over 100 years, it's still a great product, but you have to design it on a realistic return assumption up front. And as long as you do that in that, 4 to 5.5% range, awesome. But if you have an agent saying, oh, you're going to get 10%, look at the S&P 5, and they don't even realize the dividends are taken out or it's capped, again, that thing's going to implode. So great product if it's designed with attention to detail. If not, you're going to have the same issues that we had in the 1980s, 30 years down the road. And unfortunately, I've seen how people sell these things and they make them look as good as possible because they just want it to earn the commission and sell it. And I think we're going to have there's going to be a huge black eye on IULs. But there are IULs that are well designed under conservative return assumptions that are extremely good policies for older people that, again, are focused on death benefit and focused on their health. They can pay a lot less to get the same results for their families.
Yeah, coming back to the beginning of our conversation with universal life, there's a lot of flexibility in how you can design product. So if you go the first route, which you mentioned, current assumption universal life, where there isn't any guarantees, if you recommend it to a client and say, this death benefit is going to cost X based on these assumptions, and if you're not reviewing it every year, and if those assumptions aren't meeting expectations, if you don't go back to the client and say, hey, expectations weren't what we thought, we have to pay more, the policy is going to implode. It might not implode, it will implode. But that's a conversation advisors never have. So either be responsible in how you are designing it, or make sure you're reviewing it with the client every year. And if more premium needs to go in, put it in.
Absolutely.
Because you don't want what you just mentioned, which is a client in their mid-80s with no insurance when they thought they had it.
Absolutely. So, I think these, again, every one of the products we mentioned can be on an extreme scale. Like a term policy can be extremely bad if you're like not investing the difference. It can be extremely good if you're a young family and you need $5 million of insurance, you can get it really cheap. A whole life policy can be extremely bad if you're a young person making $100,000 and you haven't touched your 401k and gotten the free money, you haven't done the Roth. You're single and you're like, or it can be extremely good. One of the best tools as part of your financial plan, if you're a high income earning executive doctor making over $500,000 a year, yeah, it should be your safe money. It should be your long-term care. It should be your risk management, your death benefit. So there are in extremes, and you have to make sure that you have an advisor that's able to recommend the right product. And the universal life, you have to have an advisor that, if it's guaranteed, awesome, the expectations and the assumptions are up front, are designed correctly, or you have an advisor that's going to meet with you every year. And that's huge. So a lot of advisors will sell this, and then you're never going to hear from them ever again.
And that's the biggest issue.
And so, I agree with you. I have no problem with the ULs as long as you have an advisor, or it's part of a financial plan that you're reviewing it every year.
Yep.
I mean, that may be the right thing. Maybe you can throw in 50, and Matt, if this doesn't do that, we're to be a little bit more aggressive on the assumptions. If this doesn't do what we thought it was to do 10 years, I'm worth 10 million. I can throw in, I can catch it up, right? And then it still may be the best product, but you have to set those expectations up front. And I would say the same exact thing for the IUL. It can be really good or really bad. So again, you have to work with an advisor that it's a good for you, and it's a good support system for your financial plan. But any other closing thoughts? I think that's a good overview of the landscape.
Yeah, I think just understand the products before you make a decision.
Absolutely. Jimmy, any closing?
Yeah, just make it a part of your plan and make sure it's reviewed. If you buy a policy and you don't review it for 20 years, again, we don't want any unwanted surprises. So, it's a part of our client's plan, and it's reviewed the same way we review any equity position.
Absolutely. All right. Well, thanks for joining us, everybody. We'll catch you next week. Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.